In this session, let's talk about the interest rate futures, wherein the key aspect that I am going to look at here. Initially, we'll introduce the day count conventions and typically the quotations of the bond prices. What is the way the typical kinds of bonds are quoted in the market? So, in this, we'll also introduce the concept of the accrued interest as well. Then specific kinds of futures which are interest rate based, wherein we'll talk about the treasury bond futures. What are the key significant elements that are associated with the treasury bond futures? We'll spend some time discussing the Eurodollar futures. Then if I am using the hedging using futures, especially how can I use duration as a mechanism to hedge using the futures? And overall talking about the hedging of the portfolio of assets and liabilities using the futures. This is what we are going to look at here. So initially starting off with the day count and the quotation convention. See, generally, okay, we let's say we have got into a bond at time 0 and it's a 2-year bond. Now I know that after 6 months there is a coupon that would be paid. After 1 year there is a coupon that would be paid. After 1.5 years another coupon would be paid, and after 2 years the coupon along with the principal is paid on the maturity. Now let's say this is a tradable bond, and let's say the person wants to surrender the bond somewhere here. He wants to sell off his bond somewhere here in between, or probably somewhere here, right, which is let's say 1.2 years from the starting. Now because he has held the bond until this much period, he has received the coupon here, fine. He will receive another coupon here and another here, but what about the coupon up to this? Now this is where we are talking about the interest is getting accruing over time. So we know what is the interest that would be paid between this and this, which is the coupon. But what would be the interest between this and this? We don't know, because this is not actually paid by the company. Company pays coupon only here and here. But what if the person held the bond only up to this much, not up to this much? Will he have to forego the whole amount? Or is there any other procedure? So this is where we are computing what is called as the accrued interest. Right? Because up to this point 2 years, because the person has held the bond, the interest would be accrued over that much period. We know what is the interest over this half year period because that's a coupon. Using this, I want to compute what would be the interest in this smaller period. I know what would be the interest between this 0 and 0.5, which is represented by the coupon, but I want to know what is the interest during this period. Now this is where I am looking at the day count convention. So what is the procedure in which I compute the accrued interest during the smaller periods of time? And this is what we are expressing as the x by y, wherein we are talking of x is the number of days between, let's say this is the first coupon after 1 year, this is after 1.5 years, and let's say this is somewhere in the middle. Now I want to find out number of days between these two divided by the number of days between these two. So this is x, this is y. X by y is what I'm calling as the percentage. So the x by y times whatever is the coupon that is associated with this entire period. Let's say if it is a 6% coupon, then 3 per semi-annual. So x by y times 3 would be the accrued interest for this entire period, for this period up to the settlement. Now in the determination of the number of days for this as well as this, there are three kinds of conventions that are there. One, so for that, let's take one example which will make things easier for us. Right, I think I have taken one example, so we'll let me take this example that will make our understanding easier. I'm assuming that a bond principal, so principal is $100, coupon payment date is March 1st, so let's put it in a spreadsheet. Okay, the principal amount is 100. Coupon payment dates are March 1st. So the coupon is 1st March, let's say 2015, and September 1st. Next coupon is September 1st, 2015. Right. Suppose we wish to calculate the interest earned between March 1st and July 3rd. I want to calculate between, so the settlement date for me is July 3rd, 3rd July 15. Alright. Now, so in this case, I want to find the accrued interest that is coming up in all the three methods. Now, when I am saying actual and actual to actual is X is actual, Y is also actual. This is the method that is traditionally used for the treasury bonds. So, the actual number of days between this and this is calculated. Right, this is where the right from the last coupon paid date to the settlement date. I want to find out the actual number of days. Right, exact. Similarly, I will find out the exact number of days between this and this. And that is what is giving me the value corresponding to the accrued interest. And now here we are talking about the coupon is 8% per annum in this numerical. So let me take the coupon because anyhow it's a semi-annual. So we'll take it as $4. We'll take it as $4 per semi-annual. So if I am using actual to actual kind of a mechanism, right? So what is the ratio? I'll find out the value of X for me, which is the exact number of days between the 1st March and the 3rd July. So I'll take it as the 3rd July minus the 1st March. So I have 124 days between these 2 days. Similarly, if I have to compute Y, which is the difference between the two coupon days, right? Between the two coupon days, this is around 184. Now X by Y for me anyhow is 124 divided by 184, and based on this if I have to compute my accrued interest, X by Y times the coupon is what I am trying to go with. So the accrued interest during this period, if I go with the actual by actual, which happens generally for the treasury bonds, the accrued interest during this period is 2.69. Right? Now, the next method that I am looking at is 30 by 360 kind of method. In this 30 by 360 kind of a method, if I have to find out, the X and Y are chosen in terms of completed months. Right? X and Y are chosen in terms of completed months. Alright. So what does that mean? Okay, now I want to find the difference between this and this. So 1st April is one completed month. 1st May is another completed month. 1st June is another completed month. 1st July is another completed month. Right? So that's how I am going to go ahead. Month on month. So here it is like I'll take first of all the number of completed months. Let's say I am using a formula called date diff to compute that. I'll take this as the start date, I'll take this as the end date, but I want to get this information in terms of completed months. So it says that 4 months are completed. So I really want to find out the exact date that is corresponding to 4 months. So I'll use the E date as a formula, which will tell me that 4 months from now, the exactly 4 months from the beginning. The time period is somewhere equivalent to, the date is somewhere equivalent to 1st July. Now what I am trying to find out is the balance number of days, which is the settlement date minus this. So the total number of days, if I go with this, every month is associated with 30 days straightforward. So I will get the total number of days as 4 times 30 plus 2 days extra, giving me 122 days. So that would be here. In the actual by actual, it is 124. Whereas if I am going by 30 by 360, it is 122 days. Generally, this is a mechanism that we are using for corporate bonds as well as the municipal bond. The same thing goes with Y. The full year is taken as 360. So here also I can find out the exact number of months that are completed between the coupon date and the next coupon date in terms of months, which will give me that 6 months are completed. And if I'm going with the 6 months exactly, I know visually at least the exact date 6 months from now is going to be the same, 1st September 2015. So additional days, I really don't have any. Additional days are 0, which means the total number of days I'm getting it as 180. Now here if I find out x by y, it is 122 divided by 180, giving me 0.67, and that is what will go as an input for me in the computation of my accrued interest. Using this mechanism, my accrued interest is 2.71, slightly higher in this example compared to the actual by actual case. Now the third one is actual by 360, which we have already, computations wise, we have already used the actual by 360 mechanism. So the numerator is actual. So x I'll take it as actual. Y I'll go with the 360 mode. So based on these two, I get my x by y, and based on this, I'll compute my accrued interest. Now in this case, the accrued interest is 2.75, which is differing in all the three cases, right? Actual by 360 is generally used by money market instruments. So the denominator I take it with respect to 360, but the numerator I take it on an actual basis. These are more and more specific to the United States for these three different kinds of bonds. Whereas this kind of convention can vary from country to country, from instrument to instrument. But yes, at least these three kinds of day count conventions. Now you see that the accrued interest calculated is different. Now when we are talking about this difference, when we are talking of a face value of 100, probably when we are looking at a face value of a few million, this difference would be much more significant. So that's where the what day count convention need to be used in what context we really need to be comfortable with. So this numerical we have already addressed. Now coming on to the next aspect, the price quotations. When we look at the US Treasury bills, generally they are quoted at the discount to the face value. They are not taken as the interest on the purchase value. See, typically whenever we talk about the interest, we compute the interest on the purchase value. But with respect to the treasury bills, we see that they are discounted to the face value. So it's expressed always on a percentage of face value rather than the initial price. So let's look at it. 91-day treasury bill. Right, if I am talking about the 91-day treasury bill is quoted at 8. Right, interest rate is 8% of the face value for 360 days. Right, we are talking about 8% of the face value for 360 days. So for 91 days, what is the interest rate? I can very well get it as 8% multiplied by 360 divided by 91, or divided by, multiplied by 91 divided by 360. So it's around 0.20222 is the interest that we have got over the 91-day period. Now, if I really have to convert it into an annual kind of a mechanism, right? If I want to express it over an annual kind of a mechanism, this is for 91 days. So, okay, this is a 91-day discount. So probably let me call it as a discount, price after discount, right? This is the discount that we are going to get. So let me first find out the discount, which is on the face value of 100. This is what I'm going to get. So price after discount is going to be, price after discount is going to be 100 minus this. So this is the price. So based on this, I can compute the interest rate, which will work out to 2.02 divided by 97, which works out to 2.064%. Right, 2.064% is the interest rate for that period. The actual interest rate is 2.064, but it would be quoted at discount to face value, which is 2.022. Now this is one point. When I look at some other instrument, it could be quoted in a different way. So we have to understand the way in which different kinds of instruments are quoted. Only then we can do the comparisons much better. So here we'll try to talk about a few terms. We have already introduced what is an accrued interest, how we compute it. But majority of the times, the quote that comes for the bond from the traders it does not include the accrued interest. It is only the quoted price based on the coupon that has been paid last time. So it's a clean price. So there is no accrued interest that is going to come up. But what the customer has to pay for purchasing it should be inclusive of the accrued interest, because a person who is selling it, let's say on July 3rd, he has held it from 1st March till July 3rd, and he will not get anything. And the person who has purchased it on 3rd July, he will get the full amount on 1st September without even holding it for 2 months. He will get the full coupon, whereas holding it for 4 months, he will not get any coupon. That can't be the case. Now this is where we are trying to say, yes, let him get the full coupon, but whatever is the coupon that is corresponding to these 4 months, this would be bundled into the price. So when the seller is selling it and when the buyer is buying it, we see that this accrued interest also goes as a part of the price that is need to be paid. But as a part of the quote offered by the dealers, that accrued interest is not considered. Only the clean price is quoted, which means an individual or any buyer of the bond, if they have to really understand how much they have to pay for that bond, it should be the quoted price plus the accrued interest that has the interest that has got accrued right from the last coupon payment date. So that relationship is something that we need to be comfortable with. Now, let's go into the specifics, especially understanding the Treasury bond futures. Two major interest rate future instruments we'll try to look at. One is the Treasury bond futures, and we'll even focus on Eurodollar futures. Now, when it comes to Treasury bond futures, yes, I'm getting into a futures contract to buy or sell a government bond at some point in time in future. So when this treasury bond, you see, in majority of the times, it's not a specific bond that we are buying and selling. Any government bond with a maturity between 15 and 25 years on the first date of the delivery month can be delivered. So that is what is the confusing aspect. That is what will create the complexity in the pricing. It's not that a 14-year, 3 months maturity bond is what is getting delivered. Here we are talking of any bond that could be delivered which is having a maturity between 15 and 25 years on the first day of the delivery. So it is up to the short position to really choose which one to deliver. The same thing goes if I am talking about treasury note futures, let's say 10-year treasury note futures. In that case, any government bond between 6.5 to 10 years of maturity can be delivered. So there is a kind of flexibility to the short position in choosing what kind of bond needs to be delivered. And many a times the treasury bond futures are quoted in dollars and 30 seconds. When I say dollars and 30 seconds, probably it is like 1 by 32 is, so if the quote is, let's say 90-05, it is as good as 95 by 32. So it's basically like 90 plus 5 by 32. Probably it could go with 90 point some 15 or 16. So that would be the typical pricing. So in case it be quoted as 90-08, it is as good as 90 plus 8 by 32. It's as good as 90.25. So it's always quoted as 30 seconds, and the way we define the 30 seconds is 1 by 30 second. Right, so they are always quoted as $1 and 30 seconds of a dollar per $100 of the face value. Now, as we said, the short can deliver whichever the bond that he is comfortable with. Obviously, when different kinds of bonds are delivered, how much the short is going to receive, right, for different kinds of bonds, how much the short is going to receive, there should be some kind of a specification, and this has been developed by the exchange as a procedure to identify how much would be the price the party with the short position would be receiving according to the bond that he is delivering. He might deliver a 20-year bond. If that's the case, what is the price that he should receive? If he is delivering a 22-year maturity bond which is paying a 10% coupon, what should be the kind of price that he needs to be receiving? So there is a kind of a conversion factor that is traditionally computed by the exchange. The way they have computed that is the quoted price which the bond would have had in case it is delivered on the first day of the delivery month, under the assumption that the interest rate for all maturities is equal to 6%. So whatever is the value of the bond, all the future cash flows of the bond, when I am discounting them under the 6% kind of a mechanism, 6% per annum kind of a mechanism, I try to find out the value of the bond and say that that would be the quoted bond price. That price is what is being taken and used as the conversion factor. So the quoted price for the bond that is delivered is directly coming from the most recent settlement price multiplied by the conversion factor. So that is the price that would be received. Whatever is the most recent settlement price for the futures, I multiply it with the conversion factor, and that is the amount that the short would be receiving. So we'll take a numerical that makes things more and more easier. So I'll look at the most recent settlement price, multiply it with the conversion factor, and add up the accrued interest. that would be the actual cash that would be received for every $100 face value of the bond that is delivered. A numerical can simplify the overall understanding of this concept. Okay, let's look at this. Let's take the example of a conversion factor computation. So generally what we do is the maturity, we round it up to the nearest 3 months. Right, so let me take the examples of conversion factor computation. We generally round up to the nearest 3 months. So look at this example, right? If possible, to the on the lower side, the nearest 3 months is what we generally consider. So I want a 10% coupon bond. So I want to find out the conversion factor first of all, getting a clarity. I want a coupon of 10%, 20 years and 2 months to maturity, and as I said, we'll round it up to the closest 3 months on the lower side, though it's not mandatory, but yes, that would be more simplifying. So probably I'll take it as 20 years. So if I want to find the conversion factor, now I know that the yield in this case is 6%, because the conversion factor is always computed based on this 6% itself, right? So which means I can directly find out what would be the price of value of this particular bond. Okay, so the value of this bond, I'll try to find out using the present value. I'll use the PV. The rate is the yield that is there. I'll take it on a semi-annual basis, so this forms my rate. Number of periods, maturity is 20 years, so I'll take the double of it. The PMT, how much is being paid, so I'll take this by 2. This is being the coupon. If required, I'll multiply it on a face value of 100. So this is the coupon that is received, and the future value, I'll talk about the face value itself, which is 100. Now if I am looking at it, the value of this bond is coming out to around 146.23. If I take the negative of it, 146.23 is the value of this bond, and I divide this by the face value, I get my conversion factor. So conversion factor for this kind of a bond is around 1.46. So any kind of now if there is any other bond, so now I'll look at the futures price, the most recently quoted futures price. I multiply it by this conversion factor to talk about what should be the amount that should be received by the short position on this bond. Similarly, when I am looking at the other case, 8% coupon bond with 18 years and 4 months to maturity. So now if I am looking at another, just for an example, coupon is 8%. We have 18 years and 4 months. So maturity wise, I take 18.25 years, right? The yield on it is coming out to 6%. It's always the same, right? The yield, I'll still take it as 6%. So based on this, I can compute the value, which can come out again using the PV. So it hardly matters if I take the rounding, but yeah, the process generally is the rounding part. Okay, the rate wise, I talk about this percent by 2. Then I'm talking about, yeah, here it would be better if I take it to 18 first of all, right? So which means I am moving myself 3 months down the lane. After a moving of 3 months down the lane, I'll again get it back to the current value. So value at the end of 3 months is coming out to be, I'll use the present value. So my rate is going to be this by 2. Then at the same time, I have my number of periods, which is this multiplied by 2. Then this by 2 times 100 is the coupon. and face value. So obviously I am having 121.83 is the value of this bond at the end of 3 months. Now the current value is what I am interested in finding out. So I have to discount this by another 3 more months, right? And I know that the 3 months is 6% per year. So I can very well discount it by around 1.015, which is per 3 months. So which will work out to around 120.03, and based on this I can talk about my conversion factor, which will come out as 1.120 divided by 100 face value, which will give me around 1.20 is the conversion factor. So for different kinds of bond, now if someone is delivering a 20-year bond, the conversion factor is 1.46. If someone is delivering this, the conversion factor is 1.2. So we are able to understand why different conversion factors are going to come up for different kinds of bonds. Now, the next point that comes out is, okay, any of these bonds can be delivered. Now, a person can choose to deliver either this bond or this bond. Now, which one will he directly choose? Now, this is where the concept of cheapest to deliver bond is coming, because either he may have that bond and he may sell it, or he may buy the bond in the market and sell it, right? He may buy the bond and sell it as well. So he will always look at the cheapest to deliver. So how much he is getting? Obviously what he is getting is the quoted futures price times the conversion factor. This is what he would be getting. So how much he has to pay? I'll look at the quoted bond price. So this is what he will pay for buying it. This is what he will get. So obviously this is his payment. This is his receipt. So the difference between these two should be much higher. Or the other way, the quoted bond price, which is the cash outflow to buy the bond, minus quoted futures price times the conversion factor is the inflow that he is getting. This value should be the least possible, and for whichever bond it is the least possible, that would be typically the choice that would be delivered by the short position. And this we have seen that there could be many bonds that could be delivered, different coupons, different maturities, as we have seen. So obviously the cheapest to deliver is what would be preferred by the short position, and this is what is the way they will compare which one is the cheapest to deliver. Now let's look at the numerical, which is talking about the cheapest to deliver. We are talking about the quoted futures price. We got it as 93.25. Now you see the notation. 9308 is nothing but 93 plus 8 by 32, or 1 by 4, 93.25. Now we are talking about three bonds, right? 1, 2, 3, right? The bond quoted prices, right? Quoted bond price is 99.5 for this, 143.5 for this, and 119.75 for this. So these are the prices at which these bonds are available in the market. Conversion factor has been computed based on 6%. 1.0382 is the conversion factor here. 1.5188 is here, and 1.2615 is here. Now obviously I can find out the quoted bond price minus quoted future price times the conversion factor. Okay, quoted bond price minus the quoted future price times the conversion factor. So this is what are the numbers. So whichever is having the least, obviously the second one is having the least from this calculation. So the choice would be for the second one. So it's better that I deliver the bond which is quoted at 143.5 and the conversion factor is around 1.51, because receipt wise on this bond I'm going to receive 141.62, and I have to pay 143.5 toward the purchase of the bond. My cost is minimized only in that particular case. So I would be preferring going for a delivery of that particular bond. So if I look at the different kinds of factors, different ways of analyzing it, if the market yield of the bond is greater than 6%, if in the market, how do I really look at which bond should be a better one? If in the market, the bond yields are much above 6%. So in the market, I am able to deliver, or I am able to earn much higher return. So there is no point in delivering a low maturity, earlier maturity kind of a bond, because I am getting much better interest rate. So I prefer long maturity bonds to be delivered. Obviously, the conversion factors would be much higher for them. Use a low coupon, so it's like more delayed kind of stuff. So try to deliver a low coupon, because in every case, if I delay it, all that coupon that is delayed, it would get a much better return. So the focus would be for low coupon and long maturity. But whenever the bond yields are much lesser, I'll look at the opposite. I look at a high coupon, shorter maturity kind of bond. And at the same time, if the curve is upward sloping, means interest rates are going to go up, then obviously look at for the long time to maturity. So it's always, the more and more are the interest rates higher, I prefer the longer term maturity ones. The moment the interest rates are going down, I prefer the shorter term maturity bonds to be delivered. Now, going into the next aspect, how do I actually determine the futures price for this treasury bond? First thing, it's very difficult. The reason being the flexibility that is available with the short position. Timing of delivery, not sure. Choice of the bond that can be delivered, not sure. So if that's the case, how can I really value the futures? Now this is where we look at, if at all I am assuming that it is known, it can be as good as valuing a forward contract with a known income. So I can very well look at it in that same model. So from the current spot price, I reduce the present value of all the future incomes that are going to come up and multiply it with e power RT. Let's look at one numerical example that can simplify our understanding altogether. Okay, suppose that in a treasury bond futures contract, the cheapest to deliver bond, now this is known now, right? The choice of the bond is really not known, but here in our case, so once it is known, that is what we made as an assumption. Once it is known, that formula should be applicable. So this is where we are saying the cheapest to deliver bond will be, okay, CT, I'll talk about a CTD bond, right? For this CTD bond, I'm talking about coupon, which is 12%, fine. Conversion factor is 1.6, agreed. It's also known that the delivery will take place in 270 days. So maturity for this bond is 270 days from now. Coupons are payable semi-annually on the bond. The last coupon was paid 60 days ago, which means the next coupon date is 122 days. Right, the next coupon date is 122. The term structure is flat. Rate of interest is 10% per annum. Assume that the current quoted bond price is 115. So I really want to find out the quoted futures price. This is what is my requirement. Alright. So this is the CTD bond, the coupon. So based on this, I really want to find out my quoted futures price. Now you know the relationship already, right? The relationship for me, I always want to look at the quoted futures price times the conversion factor. Sure, this is what is the amount that I am going to receive. And on the other side, I am looking at it as a quoted bond price which I have to purchase. Now, taking these inputs into consideration, let's go step by step. Now, let's look at the step by step aspect. Okay, look at the bond first. The quoted bond price is 115, but there is an accrued interest on that bond because the last coupon was 60 days back. Now I require the coupon for this 60 days. So accrued interest for the 60 days, because the bond was declared, the coupon was declared on the bond was 60 days back. So the quoted price is 115. So the actual cash price will include the accrued interest also. So accrued interest, I'll take it as 60 divided by the coupon date plus the next coupon date. So last to the next. So totally there are 182 days, and out of that 60 days have already passed. So on that I'll take the 6 as the coupon. 12% is annual, so I'll take the semi-annual. So overall the accrued interest is coming out to around 1.97, which means from here first step goes cash price for the bond. The quoted price is 115. The cash price which a buyer has to pay for it is accrued interest plus the quoted price. So now I know that the cash price of that bond, which is the dirty price. The dirty price of the bond, I am looking at it with the accrued interest, which is making it 116.97. Now, the next coupon is going to come in 122 days, but the maturity of the futures is 270. At least after that, again if I add the next coupon, probably this is 182 days, so the next coupon will come after 183 days, right? Because in a year. So if one half is 182, the other half is 183. So I can very well assume that the next coupon will not be there within this 270 day period. So obviously, okay, the next coupon, which is the income. Income is the next coupon that is going to come. So it is coming out to be 6. I'll find out the present value of the next coupon, because that is what I have to subtract from the current spot price. So the present value of the coupon, 6 by e power RT, 6 by e power R, I'll take it at 10%, but T becomes more crucial, which is 122 divided by 365. This will become my present value. So present value of the next coupon is working out to be around 5.80. So from here, I should be able to find theoretical futures price, or no arbitrage futures price should come out as S0 minus I, which is the present value of the coupons, into e to the power of RT. T, I'll take it as 270 days. Okay, so let me look at that same formula. This is the formula which we are applying now. S0. Now this S0 is a dirty price minus I, present value of the future cash flows, multiplied by e to the power of R, which is 10%, times T. T, how many more days? 270 days is the expiry. So I'll take it 270 by 365. Working out to theoretical futures price works out to 119.711. So this should be the futures price. But look at it. Now, for this bond, There are a few more days. Now, if you look at maturity and the coupon. So there is a coupon. This was paid at this time, but it is getting matured here. Means there is a coupon that has been used. The next coupon used for probably 148 days, 270 minus 122. So the next coupon is already used for 148 days. So that should be removed from the futures price. So I will look at it as updated futures price. If I have to look at, it's as good as from 119, just like the way I have added the accrued interest. Here I have to subtract the accrued interest, right? Because the coupon is going to come in the next period. So if I have to subtract this accrued interest, I need to know how much is the accrued interest. So for that I am taking 6 multiplied by 148 divided by 183. The days in the next coupon cycle. So this much amount needs to be subtracted. So updated futures price accounting for that next coupon as well, 119 minus 4.85, which works out to 114.858, and this is the updated futures price. Now applying the conversion factor, which will tell me that updated futures price divided by the conversion factor 1.6 should be the typical quoted futures price for this kind of a bond. So this is the way we compute the quoted futures price. Depending on the first, from the bond we are finding out the accrued interest and then the cash price of the bond, and based on that we are finding out the futures price, and obtained futures price we are adjusting for the coupon that are still pending, and on that updated futures price we are dividing it by the conversion factor to typically arrive at the quoted futures price. So that's the way out computing for a treasury bond futures. Fine. Now the next one which we are looking at in this context is the Eurodollar futures. First of all, Eurodollar is nothing to do with euro. Any dollar that is deposited in a US or a foreign bank outside the United States. Any dollar deposited outside the United States is called as Eurodollar. Similarly, any yen that is deposited outside Japan is called as Euro yen. So basically the domestic currency that is deposited non-domestically is corresponding to that euro currency. Okay, so the rate of interest is basically on the euro dollar deposits that are being made by one bank with the another. And you have a futures contract there. And generally the specification is it would be paid on 1 million for a future 3-month period. The general specification is for a future 3-month period paid on $1 million. So either it can be used for speculation of the 3-month interest rate or to hedge your exposure that would be coming up for 3 months period in the future. And they have these kind of maturities, and almost up to 10 years we have the different maturities associated. And always the contract is designed in such a way that 0.01% move, because we are saying 1 million or 1 million is the face value. Now on this 1 million, if I assume a 0.01% move, which means 0.0001, and this is for a 3 months multiplied by 0.25, this will exactly come out to 25, which means a 1 basis point move will result in a gain or loss of $25 per contract. So you can directly get in terms of the calculation. And anytime once I have the quoted futures, right, once I have the future quote which is Q, I can find out the contract price using this kind of a mechanism. So wherein I am taking out, and the quoted futures price, I subtract it from 100, then I multiply it by 0.25, that entire value subtract from 100, multiply it by 10,000, which would result in the total contract value and any increase or a decrease. So let's take one example. If I take the quoted futures price as 99.25, now what should be the contract price here? Let's find out the contract price. So the contract price will go as 10,000 multiplied by 100 minus 0.25 times 100 minus the quoted futures price. Right, let's do the calculation, which works out to around 998,125. Now let me talk about a 1 basis point increase or a decrease in the futures quote. Right, so the quoted futures, let's say I talk about 99.26. So let me make a note of this, 998,125. Now let me change this to 99.26. You see that this is becoming 150. So there is a gain of $25. You make it 2.4. You make this 2.4. This is resulting in 998,100. Again a loss of 25. So the quoted futures price, based on that quoted futures price, we are trying to compute the contract price, which is coming out in this. So long is gaining when the interest rate is falling, and the short is gaining when the interest rate is rising. Right, so that's the typical way we are looking at this contract, because the contract value is either going up, which means that's a kind of a borrowing, that's a kind of a payment the long has to pay. So there is a loss of $25. Now if it becomes 99.26, then it means that the interest rate has gone down. The interest rate has gone down means it is the long is ending up paying this much, which is higher than this. So obviously there is a loss of $25. Then a few interesting points regarding the euro dollar. A comparison when I am doing it with a forward rate agreement, to a large extent they are the same, because in both the cases we are locking in an interest for a particular future period. But what we really observe is, for shorter term periods, these differences are not that significant. But for longer dated contracts, because of the daily settlement, the mark to market thing that happens in case of a futures, we see that the differences are very much significant because of the daily settlement that happens with the Eurodollar futures but not with the FRA. Now this is where some small calculation is coming into picture. The formula has come out, which includes the convexity adjustment, which says you can get the forward rate from the futures rate. You subtract half sigma squared T1 T2. T1 is the time to maturity of the futures contract, and T2 is the time to maturity of the underlying in the futures contract. So the interest rate when it is maturing, and this is the maturity of the futures contract, and overall we are looking at the standard deviation of the short term interest rate in 1 year on a continuously compounded basis. So this is what is giving me my forward rate in the computation. Now look at an example. We have a sigma, right? We have a volatility which is sigma being given by 0.012. We wish to calculate the forward rate when 8-year Eurodollar futures. So the Eurodollar is, so this is T1. Eurodollar futures is expiring in 8 years. The maturity of a 8-year Eurodollar future price is quoted at 94. Okay, the price of that is 94. The futures rate is 6% per annum. So because Eurodollar future is anyhow a 3-monthly one, T2 will come out directly as 8.25. because it is for 3 month. The Eurodollar one is for a 3 months. So the underlying is going to expire by another 3 more months, making it 8.25. Futures rate is 6% per annum on an annual by 360 basis with quarterly compounding. So futures rate. So we are talking about 6% on a quarterly compounding kind of a basis. So I really need to get it into a continuous compounding. So how do I convert it into a continuous compounded futures rate? This one I have to convert it. So this is with a quarterly compounding. So I'll get it as. So I should be able to write it like this: e to the power of RC is equal to 1 plus RQ by 4 to the power 4. Right? So this RQ is coming out to 6%. So probably I can very well find it out. This is on a annual by 360 kind of a basis. So I may have to convert it even into a 365 basis. So this is 6% on a 360 kind of a basis. So probably what I should do is, first let me compute. So this I should not take it as to the power 4 then. So this is 6% by 4 and I have to take it as 365 by 90 instead of taking it as 4. So this will work out to me. My RC will come out to be logarithm of 1.015 to the power 365 by 90. Otherwise this can come out as 365 by 90 times the logarithm of this. So we can very well compute the continuously compounded futures rate, which is going to be 365 by 90 times log 1 plus 6%, so 1.015. So when I am doing it on a continuously compounded basis, the futures rate is coming out to be this. I could have done the convexity adjustment using this formula, which is half sigma squared T1 T2. So I'll get it as half. This is the sigma, so I'll take it as sigma squared T1 and T2. So this is the convexity adjustment. So from here I should be able to compute the forward price, which comes out as continuously compounded futures price minus the convexity adjustment. So the forward price in this example is going to work out to 5.56 for this specific case. And size of the adjustment increases with the time to maturity, as we are very clearly seeing it. The longer is the time to maturity, T1 and T2, both of them would be much higher. So the size of the adjustment is going to be much higher. Then, if at all I want to create a hedging strategy using futures, first thing is duration based hedging. I am always looking at, if P is my portfolio that I have to hedge, I'll multiply it with the duration, right? So this is the total exposure for me. Similarly, if the value of the futures, VF is the value of the one future contract, I'll even take the duration of the futures with which I am hedging this. So this would be the amount that would be, this would be the amount of, this would be the typical duration that would be hedged by 1 unit of a futures contract. Now divide these two, that is what will tell me, that will make my duration almost neutral. And this is what we call as a duration based hedge ratio or price sensitivity hedge ratio. It will make the duration of the entire position equal to 0. And here when we are using a treasury bond futures, so the F which we are using is treasury bond. Now there should be a clear estimation in my mind which of these bonds would be delivered, which would be the cheapest to deliver kind of a bond. I'll try to find out the value of that particular futures. I'll try to find the duration of that particular bond, and for that I'll try to assess what should be the number of contracts that need to be entered into. Similarly, when we are using any other interest rate futures, we are trying to understand that the interest rates and the futures prices, they always move in the opposite direction. Interest rate goes up, interest rate futures price is going to go down, and vice versa. So the hedging position has to be decided accordingly. Price and the rates are always going in the opposite direction. And any kind of a portfolio that we are creating, especially if I have assets and liabilities like a bank book, we see that if I match the duration of both the assets and the liabilities, we are immunizing our portfolio for any kind of a change in the interest rates, especially by smaller amounts. So we are ensuring average duration of the assets equal to average duration, which can help us in small parallel shift in the interest rates. They will not impact our assets and liabilities. But as we have already looked at earlier as well, if there are non-parallel shifts or if there are large kind of shifts in the interest rates, the duration based hedging is not going to solve any purpose. And for the large shifts, we have already discussed that convexity based hedging will typically try to address the problem to a large extent. And we always see that the short term rates are more volatile than the long term rates, and there need not be very perfect correlation that is existing between the short term rates and the long term rates. So this is what I wanted to cover as a part of this session, where we have spent a decent amount of time trying to understand the various day counts and quotation conventions, discuss a good deal on the treasury bond futures, quoted bond price, quoted futures price, cheapest to deliver kind of bonds, some kind of concepts associated with that. We tried looking at the Eurodollar futures and how do I differentiate between a forward price and a futures price associated with the Eurodollar futures, convexity adjustment in that. Then towards the end, a quick understanding of the duration based hedging strategies using futures and hedging portfolio of assets and liabilities using futures. All right, thank you.